How to trade with the Japanese candlesticks, beginner course for beginner traders in the financial market. This is the foundation of reading price action, right? So I am going to show you everything you need to know about the Japanese candlesticks. This is the beginning, this is the foundation. So in this tutorial, I will first introduce you to what makes the Japanese candlesticks. Before we get started with the Japanese candlesticks, you guys need to know there are different ways in which price action can be represented on the price chart, and Japanese candlestick is one of the options, and they are one of the commonly used options in which price action can be represented on the price chart. So we have alternatives to the Japanese candlesticks, such as the line chart. We have the Western bar chart, but we are not going to talk about the Western bar chart or the line chart in this tutorial, right? I have separate videos if you are interested in line chart and the Western bar chart, how to use them. You can access the videos through the link in the description of this video. Before we get started, we need to know the history about Japanese candlestick, what brought about Japanese candlesticks, and what made it to be popularly used nowadays. So in the 15th, 16th, 17th, 18th century, the majority of the traders trade with the line chart and the Western chart. So, but there are a lot of information which are being missed in this way or art of charting, and this made traders to start making research about the better way to make or to represent price action on the chart. And this made a man called Steven Nielsen to travel all the way down around the world, and then eventually he got to Japan and he got a better way of representing price actions in the market, and this resulted into what we call the Japanese candlestick. So the man who originated this art of charting was called Homan Muhinisa, right? So this man was a wealthy man. He made a lot of fortunes through the advantage of using the Japanese candlestick. So this is why during our journey, during our career in the Japanese candlestick, you're going to be hearing some funny names, some Japanese names like Arami, Aikeke. No, you're going to hear some Japanese candlesticks names. I mean Japanese name, right? So so this made Steven Nielsen to adopt this mode of charting, and after traders started using this in the West, they discovered this form of charting was so simple, easy to understand, and it offers more information, right? So this is why you can see today it is the most commonly used means of representing price actions in the market. So before you can read each candlestick that form right here, you can see we have a kind of a line green, red, line green. I know by now you still don't understand what this is all about, but at the end of this video you will know what each candlestick right here are all about. So first thing, before we can know what this candlestick are all about, I need to make some drawings right here on our price chart. So you have to picture market opening at a point. So we have two participants in the market, which are called the buyers and the sellers. We have the buyers, right? The buyers move price up, right? And we have the sellers move price down. We have the sellers, they move price down. So the actions of the buyers and the sellers can be represented through printing of Japanese candlesticks in the market or on the price chart. So now let's wipe this out. Now we are going to form a Japanese candlestick right here. So the bar right here is going to be for the sellers. So you can represent your bearish candlestick with any color, but the red color is popularly used for the bearish candlesticks, okay? And we can represent our buyers candlestick with green. So it is commonly used, green is commonly used. So this is our buyer right here, this is our buyer, and this is our seller, right? So we are going to name these candlesticks so that you guys can know this is the seller in this market. This is this seller right here, seller. So we are going to change the color to be red. So this is the seller in this market, right? And we have the buyers right here. This is the buyer in this market, right? You can see that. So we change this color right here to be green. We have buyers in this market. So this is the buyer, this is the seller. Now, how do we know this is a seller, this is a buyer? It's not just by the color of the body, but through the opening and close of the candlesticks, right? Now, I'm going to mark another line into this candlestick right here. I'm gonna copy this. So we have one right here all the way down, so we can change the color to be green. Okay, so now we have this candlestick opening at this price level right here. Remember, the sellers push the price down, right? And on this bar we have price opening at a low and buyers push the price up. So before we can know if this color or if this candlestick is a seller or buyer candlestick, there's something we need to know, which are called opening and close. So for a candlestick to be a seller candlestick, it has to open from a higher level and then close to the lower level. Likewise, for a candlestick to be a buyer candlestick, it has to open from a low and close at the top. Now let me mark this level right there. So we have this right here. Let's move this right here. Right here we have the level right here. Now as you can see right here, we have right here as the open, right? So we call this right here as open. We can change this color to be black. So this is the open of this bar, right? This is the open of this bar right here. This is the open, this way it's open, and then we have price rally all the way down. So whenever it's rallied down and it closes at that down is what we call what? We call the bearish candlesticks. So the same thing happens right here, but at this time on the buyer's candlestick it was opposite. So we have the close on the buyer side at the top, and we have the open at the buyer's side at the low. Now you can see the difference right here. At this level right here, we have price opening at a higher level, close to a lower level, but on the buyer side it opened from a lower level and it closes at the higher level. You can see that. So that is the difference. Now and again, you guys are gonna see we have some high, some top line at the top and the bottom. So what are these lines at the top and the bottom all about? These lines means a lot in trading. Now let me show you what they mean. So at this level right here, it means when the sellers open the price right here, you know, this is the open, the buyers get in and push the price up. So as they were pushing the price up, this color is going to be green. It's going to be green. So when they push the price upward to this level, the sellers came in aggressively and they pushed the price downward to the open again. Eventually the bears continue to push the price more lower, and they push the price lower, and they close right here. Okay, so this is what gives us what we call the high. So this is the high. So we are going to represent this right here as a high. So they gave us what we call the high. So this is the high right here. So we have what we call the high. Okay, so this is the high, but sometimes you can hear the word high. Some traders can call it upper shadow. Of course it is an upper shadow, right? Whereby some traders can call it upper wick. So whenever you hear any of this name right here, it means what? The highest point reached by this bar, by this candlesticks. So this is the highest point on this candlestick, the high, upper shadow or upper wick. This is the highest point, right? And then on the bullish candlestick as well, this is the highest point reached. So we have this right here. Let's shift it to the other side. So we have the upper shadow, the upper wick, or the high. This is the high of this bullish candlestick. And there you can see at the low, we have a low right here, which means this would be the low, or the lower shadow, or the lower wick, right? Now we can replicate this once again to be right here as the what? As the low. So with this time around, it's going to be low, going to be a low or lower shadow, right? Or what again? Or lower wick, right? So this means this is the lowest zone reached by the price. Now let me explain what happened at this lower level right here. You can add this as well on the bullish candlesticks. So let's get this for the bullish candlestick right here. So right here we have the low right here. You can see that. Now what happened at this low? So at this low right here, when the sellers got to this level, they pushed price more to this level, but instead the boost set in. When the boost set in at this level, they push the price upward, the resisted price, and price close at the level here. So the actions we got right here was the actions of the buyers. So this was action of the buyers at this level, and at this top right here, this was the action of what? The sellers. So the sellers pushed price down. At this level right here, the buyers push price up. The same thing is happening right here. So at this level right here, the sellers what? Push price down. And at this zone right here, the buyers push price up. So whenever you see upper shadow or upper wick on any candlestick, either it be bearish, bearish means sellers, or bullish, bullish means buyers. It means the sellers push price lower at the top. And whenever you see lower shadow or lower wick or low at the bottom of a bearish candlestick or a bullish candlestick, it means the buyers push price up at the bottom. So when price open at this level right here on the bullish candlestick, no, the sellers push the price down. So as the price was going down, the price turns red. When it got to this low right here, that is the lowest zone, price got to, the boost steps in and push price up. And then what happened? The color changed to green. That is to show you the buyers are active and they push the price up. When they push the price to this close, they went up ahead. And then what happened? The bear step in, the seller step in, and they push price down, whereby we have the close. So in summary right here, we have the opening low and the close above the open. This gives us a what? A bullish candlesticks. So we can call this right here bullish. A bullish. You call it bull or bullish. So these are technical names you have to understand. Bullish. So when you hear the word bullish, bull or buyer, this is what we mean. And then at the other side right here, when you hear the word seller or bear or bearish, so it means we are referring to sellers in the market. So now the question is, what is the difference between the opening and the close? So this is the opening right here, and the price close lower. So the difference between the open and the close is what we call the body. It's what we call the body. So this is the body of the candlestick. So we have body. We have what we call the body right now. Okay. So can have this right here. We have this. This is the body of the candlestick. So we can clean this off. So the difference between the open and the close is what we call the body of the candlestick. The same thing goes for the bullish candlestick. The difference between the close and the open is the body, right? So can just replicate. Let's get for another one right here. So we have this right here, you can see. So the difference between the close and the open is the body of the candlestick. So in a bullish candlestick, we have price opening at the bottom and then closes higher for a bullish candlestick. And for a bearish candlestick, price open at the higher level and close at a lower level. You can see that. So this is what brought about the bullish and the bearish candlesticks on your price chart. So with this candlestick formation, we will be able to form more candlestick patterns. All right, we will be able to form more informations in the market, which we called candlestick patterns. Right, so this is the foundation. This is what brought about highs and lows in the market. So in the next section of this tutorial, I am going to show you what we call the candlestick patterns. Candlestick pattern, because candlesticks can appear in different formats in the market. You can see right here we have different formats. We can see we have a long bullish candlestick, and we have short candlestick, and we have some candlestick we have a kind of a very long upper shadow and small lower shadow. For example, right here now we have a bullish candlestick, bullish candlestick, bullish candlestick. It means in this market we have a long bullish candlestick and we have small bearish candlestick. So it means right here the bulls are active in this market, they are stronger than the sellers, right? Likewise, in this market right here, you can see we have a long bearish candlestick. So it means the sellers are active right in this market more than the buyers. So in this type of market, if you are in a selling position, you tend to make money. And right here, you can see the bullish or the buyers are so active right here. So it means if you are buying right here, you tend to make money. So candlesticks are formed through the highs, low, open, close to form what we call the body, right? So this is what brings about candlestick, right? So let's move to the next section, how we can combine more candlestick together to give us patterns, to give us information. Because in English language we have the alphabet, right? We have the alphabet A, B, C, all the way to Z. So the same thing is applicable to trading. So in trading, we have different alphabets in trading. And this is what I'm going to be showing you in the next class, right? So if you enjoyed this video, ensure to subscribe, put a comment down, sharing your views, and enable the notification icon so that you don't miss upcoming tutorial on this video. So I will see you in the next one. Peace.